Welcome to week 4, module 2, and we're going to go over the 401k plan, which is extremely popular today. It's one of those plans like the IRA that really had a very different starting point many years ago in the 1960s and has now evolved to being a retirement plan rather than just a savings plan, and has been very popular with a lot of employers because it means the employee is picking up the cost of the retirement. It's also popular, I would say, with a lot of people in smaller companies because they can get more money off of this than some of the other plans, and they can combine this with other plans. This is the profit sharing plan. As you call, profit sharing plan is a plan that is only paid by the employer. The 401 plan is designed to be paid by the employee, plus the employer can make additions, which we're going to go over. One it cannot go with is the SEP, because the SEP is a standalone plan, but other than that there's a lot of flexibility where you could have 401k with a defined benefits or a defined contributions plan. So let's take a look at it. And the material I have here is primarily from the IRS, and let me explain why. In all the books I see about it, I see a little bit different information. Subtle information at times, but I feel more confident when I see it's from the IRS because that's who I have to live with as a enrolled agent, and so that's who I'm getting the information from this. So if there's a mistake in here, blame your government, not me, because it's really their words. Maybe the typos would be mine. A 401k is a feature of a qualified profit sharing plan that allows employees to contribute a portion of their wages to individual accounts. I might note that under today's application, 401k plan does not need to have a profit sharing plan with it. Historically it has, but over the years it has changed so that we now have standalone 401k plans. Elective salary deferrals are excluded from the employee's taxable income, except for the designated Roth deferrals if you have a 401k Roth. Employers can contribute to the employees' accounts. It is not required. Distributions including earnings are included in taxable income at retirement, except for qualified distributions in designated Roth accounts that are 401k related. Haven't seen a 401k Roth, but they're apparently out there. Overview of the plans. Let's see, with the 401k plan, employees can choose to defer some of their salary. Instead of receiving that amount in a paycheck, the employee defers or delays getting the money. In this case, the deferred money is going into a 401k sponsored by their employer. This deferred money generally is not taxed until it's distributed. Some unique features: you can have other retirement plans. In fact, it's many times found historically with profit sharing plans, although the need for that changed with some tax laws 10 years ago, but they still tend to be going together. They can be a business of any size. We have the one man or one person 401k plan, all the way to, could be for General Motors or IBM or whatever. You still need to file a 5500 because it is an offshoot of the profit sharing plan, and that means you got a lot of documentation there. You can make a 401k plan as simple or as complex as you want to. 401k plan that is pre-approved by the IRS might be just the thing to cut down administrative headaches and expenses. IRS really recommends it that you get a pre-approved plan. Again, using the templates from the banks and the mutual fund companies are a good idea, and those are what we call pre-approved. It can be simple on the 401k plan where you just have the employees put in as much as they want up to the threshold cap, or you can have it where the employer gives some based on the amount the employee gives, etc., and it's up to the company how complicated make it. The more complicated you make it, the more expensive it becomes, the more confusing to the employees. Pros and cons: advantages: greater flexibility in contributions. Employees may contribute more to the plan than under IRA plans. Good plan if cash flow is an issue, because the company doesn't have to contribute every year, just like profit sharing doesn't. And also in many cases, the company doesn't even provide anything. It's only provided by the employees. Optional participation loans and flexible and hardship withdrawals add flexibility for employees. However, you have to worry about penalties and taxes, and we'll talk about that later. The disadvantages: administrative costs may be higher than under most basic arrangements, and that is because it's not really a classical defined contributions plan. It's really an offshoot. It needs to test what benefits do not discriminate in favor of highly compensated employees. This test can be complicated, and on the last chart of this presentation, we're going to give you an example of that. Additional withdrawals and loan flexibility adds administrative burdens for the employer, and sometimes it gets too complicated. And I worked for a company that started it shortly after I went to work there, and management didn't pay a lot of attention to what they were doing, and they let someone from HR set it up, and it was a complete disaster. And it took about 4 years of working with the IRS to get it cleaned up. Who contributes? The employee salary deferrals and or employer contributions. So you can have the employees do it, you can have the employer do it, you can have a combination. Very flexible. Employees always are 100% vested in their salary deferrals. Employer contributions may be vested on a graduated vesting schedule, and we've seen that. It's 2 to 6 years, just like the profit sharing. Contribution limits: the annual additions paid to a participant's account cannot exceed the lesser of 100% of the participant's compensation or an index value. And the index value changes every year, but I think it's kind of interesting. You could have the 100% of compensation, which isn't true of a lot of the plans. There is a catch-up plan for those over 50 years old, and highly compensated employees might need to limit their elective deferrals to pass non-discrimination tests, which again is on that last chart. The maximum contributions, total annual contributions, which is the annual additions to all accounts in the plan maintained by one employer, and any related employer, are limited. So if you work for a company and then also part-time for a division of a company, that would be coming in effect. The limit applies to the total of elective deferrals, employer matching contributions, employer non-elective contributions, and allocations of forfeitures. So elective deferrals applies to the employee. Employer matching contributions is when they commit in the plan to match something, like $1 for every 3 you do or whatever. Employer non-elective contributions, a company may decide to this year give you more, or may decide each year to decide how much they're going to add, if they're going to add anything at all. Very flexible. And then allocation of forfeitures. When people leave who are invested, that money gets put back into the pool. Treatment of excess deferrals. There's an excess deferral for an employee if the total of the elective deferrals to all plans is more than elective deferral amount for the year. Employee may notify the plan administrator before April 15th of the following year that the employee would like to access the excess deferral amounts adjusted for any gains or losses be paid from the plan. And where this happens is at the beginning of the year, a person calculates that they've, as a highly compensated person, that they're in the rate ratio compared to the amount of money being contributed by the rank and file non-highly compensated employee. And then during the year it's found out, probably near the end of the year, that the rank and file non-highly compensated employees did not contribute as much or contribute less of their income, and therefore it's too much is in the plan for the highly compensated. Again, if we look at the last chart, I'm making that last chart sound kind of interesting, isn't it? I keep bringing it up, but when we go to that chart, we'll see that there's a limit that you can have as a highly compensated, and you may withdraw, and that's what this chart's talking about. Special rules: filing requirement, annual filing of Form 5500 is required, and I guess you probably realize that most of the plans that's a requirement. Participant loans are permitted, and service withdrawals, yes, but subject to possible 10% additional tax if under 59.5. Early distributions, penalty if withheld before you reach 59.5, as we said before. Hardship withdrawals if your plan allows, and again it requires the plan to allow it. However, hardship withdrawals are subject to income taxes and a 10% annual additional tax on early distributions. Employees who take a hardship distribution cannot repay it to the plan. And that's really got to be consideration because in many respects, loans might make a better idea, and we'll talk about loans in a minute. And my concern again, as always, is if you allow the people to take the hardship withdrawals and they take it out, they're just hurting their retirement. So if I was running a company, quite honest, or had control over a company, I'd tell them there's no hardship loans. Again, that's up to the company to decide in their plan, and the plan lays it out. Then there's loans, which we'll talk about in a second, and then of course the series of equal payments from now to infinity is another method. It's a joke on the from now to infinity because I've heard that several times from people. It's from now to either 65 or 59. Again, you have to go look at what it is today because it has varied in the past. Hardship withdrawals. Under Safe Harbor and IRS regulations, employees automatically considered to have an immediate and heavily financial need if the distribution is for. And before going any further, remember if you take it out, you're going to pay taxes on it and up to 10% penalty. Medical care expenses for the employee's spouse, dependencies, or beneficiaries. Cost related to purchase of an employee's principal residence. Tuition-related educational fees and room and board expenses for the next 12 months of post-secondary education for the employee or the employee's spouse, children, dependents, or beneficiaries. Payments necessary to prevent the eviction of the employee from the employee's personal residence or foreclosure of the mortgage on that residence. Funeral expenses for the employee's spouse, children, dependents, or beneficiaries, or certain expenses that repair damage to the employee's principal residence. And taking it out before 59 and a half and for funeral expense is kind of confusing to me because let's face it, if you're dead, I don't think there should be a penalty to bury yourself. But again, I never understood Congress, and they don't understand me. Maximum loan amount. Maximum amount a participant may borrow from his or her plan is 50% of his or her vested account balance, or $50,000, whichever is less. So it's the vested part, and 50 is whatever is less. So let's face it, that's the maximum is 50,000. An exception to this limit is that the 50% of the vested account balance is less than 10,000. In such case, the participant may borrow up to 10,000. Plans are not required to include this exception. And my understanding from talking to IRS is that a lot of plans do not include this exception for less than $10,000, but you should be aware of it. Employer contributions. Employer matching contributions. If the plan document permits, the employer may make matching contributions for an employee who contributes elective deferrals. For example, a 401k plan might provide that the employer may contribute 50 cents for each dollar that participating employees choose to defer under the plan. Employer matching contributions can be discretionary, contribute in some years and not in others, depending on the company's decision, or mandatory. Again, the plan is the guide, so when people are preparing a plan to have a 401k plan, they have to think out these types of problems. And should we match? Should we make it discretionary, etc.? I always think the best idea is just being as flexible as possible. So rather than having a required matching, let's go more for the non-mandatory. Let's talk about those discretionary non-elective contributions. If the plan document permits, the employer may make contributions other than matching contributions for participants. These contributions are made on behalf of all employees who are plan participants, including participants who choose not to contribute elective deferrals. Safe Harbor 401k plans. A Safe Harbor 401k plan is similar to the traditional 401k plan, but among other things, it must provide for employer contributions that are fully vested when made. I might note that this plan is it's a pretty simple plan compared to the others. These contributions may be employer match contributions limited to employees who defer, or employer contributions made on behalf of all eligible employees, regardless of whether they make elective deferrals. The Safe Harbor 401k plan is not subject to the complex annual non-discrimination tests that apply to traditional 401k plans, and employers sponsoring Safe Harbor 401k plans must satisfy certain employee notice requirements. The notice requirements are satisfied if the employer provides each eligible employee with written notice of the employee's rights and obligations under the plan, and the notice satisfies content and timing requirements. Um, Very popular today, even though the employer is making contributions, where I think a lot of people suspect today most employers are trying to get out of any contributions. But it's simple. We don't have to worry about the 70-30, I mean the 70% non-highly compensated versus highly compensated, etc. Automatic enrollment, a 401k plan under today's rules can have an automatic enrollment feature. This feature permits the employer to automatically reduce your wages by a fixed percentage or amount, and you contribute that amount to the 401k plan unless you have affirmatively chosen not to have your wages reduced or have chosen to have your wages reduced by a different percentage. Now, I might note there's a lot of pressure by some companies putting this because the highly compensated employees' ability to really benefit nicely from these plans is dependent on having the non-highly compensated being investing in it. Also, let's face it, it's a good way to have retirement for people, and I think a lot of companies don't mind having retirement for people when the employee is paying for it. These contributions qualify as elective deferrals. This is an effective way for many employers to increase participation in a 401k plan. ADP test. We finally got to that magic last chart, and the actual deferral percentage, which we talked about back in an earlier module, test required for 401k plans. The test compares the deferral rates of non-highly compensated related to the compensation with the deferral rates of the highly compensated. The actual deferral percentage of highly compensated is limited by the actual deferral percentage of non-highly compensated. In other words, what the non-highly compensated does is going to tell you how much can be taken out for the highly compensated, different than all the other retirement plans. If the ADP of the non-highly compensated is less than 2%, highly compensated may defer up to 2 times the non-highly compensated. So let's say the non-highly compensated are taking out 1%, that means highly compensated is limited to 2%. If it's 1.5%, it's limited to 3%. If the ADP of non-highly compensated is 2% to 8%, the highly compensated may defer an additional 2%. So if this non-highly take out 6%, that's 8% for the highly compensated. They do 8%, it leaves 10. If the non-highly compensated is more than 8%, the highly compensated may defer 125% of it. So if it's 10% being taken out by the non-highly compensated employee, that means the highly compensated can take out 12.5%. So it's kind of unique that the tail end wags the dog in this case. So with that, I think we've covered enough information that'll get you knowledgeable about the 401k.